Welcome to Especially Economics. The minutes of the Monetary Policy Committee's August 10th meeting show that at least two of the external members, Dr. Ashima Goyal and Dr. Varma, were a little more optimistic that the current food inflation spike can be looked through. Dr. Shashanka Bhide sounds a little more cautious. But many events have happened since they wrote their minutes and today. One, the July inflation number came after the minutes were written, and at 7.44%, they're much higher than RBI or the market forecast. Two, August rains have shown some El Nino impact and they have pushed up cereals prices. Three, the RBI MPC members, Dr. Patra and Governor Das, have called for a tightening of liquidity. There was the incremental CRR. This has pushed up yields. And fourth, Jerome Powell over the weekend sounded more hawkish than expected about US inflation. So what are the current thoughts of the MPC external members? I have with me Dr. Jayant Varma, Dr. Ashima Goyal and Dr. Shashanka Bhide. Gentlemen and Ashima, thank you very much for sparing time for us. Dr. Varma, let me start with you. Exactly the food inflation number at 7.44, indications are that August is going to be just as bad. Would you be a little more worried that food inflation may be sticky?
No, I think when we met, I think there was a fair degree of understanding that inflation these 2-3 months would be high. I think I was expecting somewhere between 7 and 8 to happen for a couple of months. So I think to me that did not come as a surprise at all. Okay.
So that doesn't require to change your views. But I'll tell you why the market and others estimate that it is worse than expected. The Reserve Bank's July, August, September quarter average forecast is 6.2. Now, if we have a 7.4 for July and a likely 7.2, 7.3 for August, chances are this number is going to be, much higher than what RBI forecast. RBI forecast 6.2, we are probably going to be 6.8 to 7%. That's the CNBC-TV18 poll. Therefore, would you change your thoughts that maybe it's going to be more sticky, Dr. Verma?
No, I think, see, monetary policy acts with fair amount of lag. And we are looking at 3 to 4 quarters ahead. So really, what happens this quarter is not something that we can control today. So we are looking at what would the picture look like 2 quarters from now, 3 quarters from now, And what happens these 2-3 months is really something that monetary policy cannot do anything about. Okay. Even if we raise rates by 5 percentage points, that will not do anything to, August, September inflation. So the point of tightening or loosening is related to what we see 3 quarters, 4 quarters, 5 quarters ahead. Okay. So this quarter, I'm really writing that off as saying that this is beyond control now. Okay. And that doesn't change the outlook for monetary policy.
Okay. Let me get Ashima Goyal's view on this. Ashima, it's not just that the current quarter will not be 6.2. It's definitely going to be closer to 6.8 or thereabouts. Now, that pushes the entire average also. I mean, the poll that we did shows that we won't be at 5.4. Probably the average is going to be 5.6. So it's not just going to be a one-quarter affair from the way the market is reading it. Your thoughts, therefore, that probably would, if you're writing the minutes today, you would be more cautious?
Well, I think I was cautious enough. I said we have to watch incoming data.
Yes.
Therefore, our position will be affected by the kind of, the events you have underlined so well. But I think the key issue really is if this vegetable inflation reverses. Because, as you said, the average will go up only 0.2% for the year, average inflation. And if inflation reverses, then by midsummer, it will be around 5.2, which suggests that our real rate is all right. So that is the key issue. And here, I think we can expect some pleasant surprises on the supply side.
Okay.
For example, the China slowdown, oil, we might see oil marketing companies passing through something. We might see further supply side action by the government. So I wouldn't base an outcome just on this last month or these 2 months. I would wait to see a little longer what other things happen before deciding that maybe food price inflation overall is going to be sticky for longer. And second, even if food price inflation is stickier for longer, cereal, pulses, etc., we still have some components that are falling, like palm oil, etc. And second, it's still something that might not affect the overall inflation because we're not seeing true second round effects, which is real wages must start rising. This is what happened in the really high inflationary period in the 2010s. Manufacturing wages, real wages are only half of what they were pre-COVID. And we are seeing employment softening, services employment softening. So this is when food prices affect wages and then affect food prices again, that it becomes truly persistent and generalized. We're not seeing that.
No, we haven't yet seen that for sure, but the food inflation has just begun. And if it persists, perhaps there will be demands for increases in DA. We also have an election round the corner. So I agree that it would be wait and watch. Dr. Bhide, a similar question to you. You actually already sounded a little bit of caution when you said that, we should worry about broadening of inflationary pressures. Those were the very words you used. And now the data has come in worse. So would you have written the minutes differently? Would you have heightened your caution a bit more?
No, I think, obviously the first quarter numbers were very good. That inflation rate was lower, but food as well. And so I think the concern was beginning with the problems with tomatoes and also July numbers. But I think the concern is there, I think, at least until September or so, because I guess this is about the time that the price rise in the case of food products, I think, particularly, there is more momentum and so on. So I think the El Nino effect or the uneven distribution of rainfall and so on, that doesn't sound very good for Kharif harvest, actually. So therefore, I think the concern is there as far as the food prices are concerned. But I think I would agree that in the case of non-food prices, the pressures, I think, are less. So that may be the reason that the overall headline inflation might still be moderate. So in terms of projections for the future, I think this quarter and the next quarter are going to be sort of difficult in terms of the food inflation is concerned. But I think the subsequent quarters, I think, would be more moderate than what we see now.
Okay. Well, we do see some international uncertainty also. And you point out to that, Dr. Bhide, that there is also global volatility in agricultural commodities. And of course, there is the hardening of crude prices. When you all were writing, we were not looking at a consistent $85, $84 for crude. Now that looks like the new normal. So, Ashima Goyal, the forecast we have of from the market for the first quarter or FY25 is not 5.2 as the RBI forecast, but 5.4. If it is 5.4, then 6.5 the repo rate minus the inflation rate of 5.4 will be only much less than what we thought. It's going to be 110 basis points. Are you okay with that?
Yes, I mean, I always said that that what I think is an appropriate real repo rate is 1% plus minus, because you can't hit it precisely. So we are still very much in that range. And I think that inflation targeting really works because they know the anchoring of expectations, because they know that the MPC is going to react if inflation rises persistently. And a real repo rate around 1% is giving you that reaction. Your nominal rate is matching the rise in inflation at present. So I think that is okay.
Okay.
That should work to anchor inflation expectations.
Okay.
And would be appropriate, because it's not so much that we are dampening demand. What is really important here, there's just one other thing I want to say. I want to contrast our experience this time with what happened in the high inflation episode in the 2010. There, if you remember, after the global financial crisis, there was a huge stimulus which was not reversed for a long time. There was a huge liquidity infusion, which was not reversed. Rates were raised in baby steps. This time, the reversion has been fast. We've reached our equilibrium real exchange rate quickly. And the government is taking action. Then the government was spending a lot in rural areas on construction and so on, which increased demand for food when already food inflation was high. And so you saw real rural wages rising. This time, the government is spending to cap food prices, giving free food, buffer stocks, etc., as well as fiscal consolidation, reducing the fiscal deficit. So again, these are factors that will prevent that second round effect taking in. And overall, you would expect headline, which is volatile, to approach a more persistent core inflation.
You know, all said and done, Ashima Goyal, the current general government deficit is still 6% plus 3%. It's close to 9%, probably 8.9%. Not very different. At that time, the government definitely increased inflation, increased fiscal deficit, but we are not at a very low fiscal deficit at this point in time. It is just lower than what it was during COVID. But let me come to the, and you never know, it's in an election year, it might even rise, but that I guess is wait and watch for the MPC. Dr. Varma, you have never given us your idea of what is the neutral rate. Do you think a 1% positive real rate is enough? There were some RBI studies, I think, which were talking about 150 basis points. What's your view?
I think most estimates would be that, one should be somewhere in the range of slightly above 1. I would regard 1.5 as too risky in terms of the growth impact. So I would be very much worried about pushing it up all the way to 1.5. I would like it to remain significantly below 1.5 and slightly above 1. 1, slightly above 1. So between 1 and 1.25 would be my preferred zone for the real.
Your thoughts, Dr. Bhide, on what should be the positive real rate?
I don't think I have a particular number. I certainly would like to have the inflation rate, projected inflation rates closer to the target that we have. I think that to me, I think that is an important point.
Okay, then I'll come back to that point in just a bit. That's very important. At 5.4, we are actually closer to the upper bound, if that's what the first quarter turns out to be. But Dr. Varma, the other thing that the Reserve Bank has done, which is not an MPC preserve, is the hike in the CRR. And Dr. Patra has gone hammer and tongs at how liquidity can fuel inflation. Now the call rate is actually closer to the upper bound, to the MSF rate. Your thoughts?
You see, liquidity management is a purely operational decision. It is the mechanism through which the RBI implements the monetary policy decided by the MPC, right? So if the market is not where the MPC is guiding it to be, then you tighten or loosen liquidity for that. So liquidity management is not a monetary policy decision, it's an implementation of a monetary policy decision. And that is an operational decision which the central bank takes, that if we want rates to be at the kind of level which the MPC has decided, then do we need to inject liquidity? Do we not? Do we need to take liquidity off? That's a purely operational decision. It is day-to-day management, which has nothing to do with the MPC.
Okay. Dr. Goyal, what would be your thoughts? I mean, the fact that consistently after the policy, the call rate has not been at the repo rate. It has been exactly 25 basis points higher. Everything, call rate, tripartite repo, all the one-day rates are at 6.75.
That's not correct. That's not in line with the MPC decision or with inflation targeting. because inflation targeting mandates that the Reserve Bank must manage liquidity. All liquidity is supposed to become endogenous. So if the rates are higher than the repo, the Reserve Bank, the VRR short-term kind of liquidity adjustment should be such as to bring the repo rate down to bring the market rates down to the repo. So we should see that happening in the future. And I think that inflation targeting properly implemented should assure the market that we will not go into very large liquidity deficits. Excess large surplus liquidity, as was there before the CRR hike, can kind of leak into the informal sector or low interest rates and fewer. Earlier, there used to be a fear of speculative food hoarding, etc. But I think when you're relying more on trade, that's not such an important issue. And you want to make speculation expensive by raising rates, not by...
Which is why I guess the Reserve Bank... Which is why I think the Reserve Bank has pulled out liquidity. You think that's fair?
Well, they didn't want too much surplus, so it was right to pull it out. But now they have to make sure that the market rate doesn't rise above the repo by injecting short-term liquidity. And if shocks are such, because in the economy you have outflows, you have intervention, etc., they can't do it through short-term liquidity, then they need to adjust the durable liquidity. But for a sustained period, market rate should not be above the repo rate. That is mandated by the MPC.
Well, to be fair, it's only about, 2-3 weeks that it is at 6.75. Nevertheless, it is. Two more questions remain. One, consistently, the inflation has not gone to 4%, barring 2 or 3 months when it came to 4.5, 4.6. It's remained above that level. I would want your thoughts. And secondly, growth everywhere is surprising on the upside. Everywhere, as in the United States and in India. Both those questions to my guests after a short break. The Bazaar team will get to Chartbusters, but you will get to hear the entire conversation at the end of the day.